If you're self-employed and trying to buy a home, you've probably been told one of these three things. Your tax returns show too little of income, or your business income is too complicated, or the worst one of all, come back in 2 years. You want to buy a house now, right? But what if none of these are actually the problem? What if the real issue is that the lender is looking at your income the completely wrong way? Today, we're going to break down the two mortgage strategies built specifically for entrepreneurs. And at the end of this video, you're going to know exactly which one fits your best business options. Now, I'm Ron, the Home Loan Dude, here to share the best strategic mortgage solutions. Go ahead and hit the like and subscribe button to stay in the loop for the best home loan options right here. Now, if you're self-employed and trying to buy a home, there are different options we can look at, and the ones we've been talking about lately is the bank statement loan and the P&L loss loan. I say P&L, profit and loss loans. So both are designed for business owners. Both can replace traditional tax return income, but here's the mistake many entrepreneurs make. They ask which one is better, when the actual best question is which one tells more about your business income. Because when lenders are looking to understand your income better, the approval comes much easier whenever they see what your business is actually doing. So let's simplify this. Think of these two loan strategies as two different lenses used to view your business. A bank statement loan looks at your cash flow. Profit and loss loan looks at your profitability. Cash flow and profitability are related, but they are not the same thing. Understanding that difference can dramatically impact your buying power. Let's start with the bank statement loan. This one kind of gets things rolling. The strategy focuses on the deposits in your bank account. The lender reviews the 12 months of deposits, determines how much income your business generates. From there, an expense factor is applied to the estimated business expenses. Usually it's 50%, but with a CPA letter, that number can go down. Now, what remains becomes your qualified income. In simple terms, deposits minus estimated expenses equals qualifying income. That's the simplified form. It works. This strategy, it really works extremely well, and when your deposits are consistent and predictable, bank statement loans are often the strongest option for business owners. Whether you're a contractor, a consultant, service professional, small business owners who are paid regularly by clients. Why? Because their income shows up clearly in the bank statements. The money comes in steadily, and steady deposits make underwriters easier to say, let's make this happen, right? So now let's talk about the profit and loss loan. Instead of focusing on deposits, the strategy focuses on the business performance. The lender reviews 12 months of profit and loss statements. And now the profit and loss statement does have to come from a CPA or tax professional. Can't just go create one and throw in numbers. This stuff has to make sense, right? The statement shows three things: revenue, expenses, and net profit. And then the net profit becomes, bingo, the income used to qualify the mortgage. In other words, revenue minus actual expenses equals qualified income. Now, this strategy often works better for businesses where deposits, they don't really tell the full story. For example, a company that might reinvest heavily into growth, businesses with large contracts that pay irregular cycles, and entrepreneurs who run significant expenses. Like if you have a lot of expenses you run through your businesses, however you might want to do that. Now, in those cases, the profit and loss statement that provides a clearer financial picture than just the deposits alone. Now, here's a thought that you need to have. If someone's looking only at your deposits, will they truly understand your successful business? Or will they not? Now, for many entrepreneurs, the answer is no. And that's exactly why the profit and loss loan exists. This allows lenders to evaluate the actual economics of the business. It's just not just cash movement. I'll give you an example. Imagine two business owners here in Central Florida. Their first one owns a residential contracting company. Payments come in weekly as projects are completed. Has a good pipeline of business. Bank statements are consistent month after month. The income looks stable. In this case, bank statement clearly reflects the strength of the business. No bank statement loan most likely becomes the most efficient strategy. Now imagine a second business owner who runs a marketing agency. Some months bring in large contracts, like cash is coming in. And then other months involve taking that cash and reinvesting it into staff and software, maybe advertising to make sure you get the next deal coming in. So the deposits fluctuate. But 12 months of the profit and loss statement shows stable profit and strong revenue. In this case, the P&L, the profit and loss strategy, it tells the lender a far more accurate story. The key lesson here is simple. Listen to this. Mortgage strategy should match the structure of your business, not the other way around. Too many entrepreneurs are trying to force their income into a structure that was designed for a W-2 employee. And that's where the frustration begins. You go to the bank, you talk to a lender, they tell you come back in a year or 2 years, or you got to stop writing stuff off. Well, that's not how business owners work. That's not how businesses operate. So here's the reality. Traditional mortgage guidelines were created decades ago, and that time, most borrowers had predictable salaries. We're in a completely different world today. Entrepreneurs are growing rapidly, and especially here in Orlando and across Central Florida, contractors, consultants, creators, and all small businesses are driving the local economy. Mortgage programs have evolved to reflect that reality. Now, let's eliminate some doubt and a common concern you might have with this. Are these loans risky or unusual? And the answer is no. Do these all the time. These programs exist because lenders recognize that self-employed income is structured differently. When properly documented, and we're going to see proper documents, and the structure is there, these loans follow clear underwriting guidelines. The goal isn't to bend the rules. The goal is to apply the right rules to the right business model. Now, here's another important point. Sometimes we analyze both strategies before choosing one, and the difference can be significant. The same borrower might qualify for very different loan amount depending on which income strategy is used. That's why structure matters. If you remember one thing in this video, remember this. Self-employed mortgage approval is not about proving you make money. It's about demonstrating your income in the clearest possible way. Bank statements highlight cash flow. Profit and loss highlight profitability. The right choice depends on how your business operates. So if you're self-employed in Orlando, Winter Park, Windermere, Lake Nona, Clermont, anywhere in Central Florida, don't assume you don't qualify, and don't assume tax returns are your only option. Your business simply needs a mortgage strategy that reflects how entrepreneurs actually earn income. Now, in the next video, we're going to take this one step further. We're going to talk about how self-employed buyers can increase their buying power before applying for a mortgage. Just a small adjustment, strategic preparation, things that can dramatically change your approval outcome. Now, if you want to know which strategy fits your business best, now's the time to do this. Absolutely schedule your call. Schedule a strategy session. There'll be a link in the description, or a calendar link there. Go ahead and click on that. Pick the best day and time for yourself. We'll review your deposits. We'll look at your profit and loss. We'll compare both strategies and build a mortgage strategy around your business model. No pressure, just clarity. Click the link and we'll start building that pathway to home ownership. And I'll see you in the next video.